Good afternoon, everyone. We're last but hopefully not least. We're the Commercial Real Estate Finance panel. My name is Pendergast. I'm with CREFC, and we have a fantastic group of folks that represent all various aspects of the fixed income side of the business. Chris, and the floating rate, actually.
That's right, yeah, and floating rate as well. Hey, everyone. My name is Chris Albano. I'm with Citibank. Been with Citibank for 24 years today, actually. In commercial real estate, yeah, right? It's been a fun ride. So been in commercial real estate the whole time. Been on the finance side of commercial real estate for the past roughly about 20 years. So at Citi, I cover I run all of the distribution of our commercial real estate mortgage products, other than CMBS. So anything that's going on our balance sheet, whether that be lending to a REIT, a revolver, a term loan, a bridge loan for an M&A, or a mortgage loan. A big portfolio loan to Blackstone, as an example. In addition to that, I cover LATAM and head up our efforts for our balance sheet in LATAM, so Mexico and South America, Central America a little bit as well, and then head up our efforts for sustainable commercial real estate. So a few different hats.
A lot of hats in 24 years. Hi, everyone. I'm Tan Bui. I am a managing director and partner at Clarion Partners, where I co-manage the debt platform there. Clarion Partners is an $80 billion AUM, predominantly in equity, and we run funds and manage money for separate accounts and the like.
Hello, everyone. My name is Lee Overby. I head up CMBS research at Barclays Capital. I spend a lot of time looking at commercial real estate and also CMBS bonds, and I spend a lot of time talking to both the sell side and the investor base about what's going on in the markets.
Hi, Harris Rendelstein. I'm an executive director at JP Morgan in the CMBS Capital Markets Group. Primarily, I cover the principal business with respect to conduit and large loan.
Hello, my name's Trifon. I am a partner and portfolio manager at Lord Abbett, responsible for the real estate credit team, and I co-lead our Core and Core Plus franchise as well.
I'm Jared Warshaw. I run special servicing at L&R Partners. L&R's, for the last 10 years, been wholly owned by Starwood Property Trust. L&R is a CMBS special servicer. We're named on roughly $105 billion of CMBS deals. And we're also active across the CMBS space. We are a CMBS B-piece investor. We're also a CMBS originator through our affiliate, Starwood Mortgage Capital.
Great. So as you can see, I think the goal here is just to give you a cross-sector of the various components of the lending side of the business, the finance side of the business. And so we'll get started right away. My first question, not surprisingly, given what it is that we do, is about rates. The Fed has moved 11 times, very aggressive, with the range of Fed funds now at 5.25, 5.5. As of the November meeting, they have held steady 3 out of the past 4 meetings, which would suggest to some that maybe the next move might be something different and better. But I do think that the amount of inflation we were somewhere at 9% at some point. It was a crazy number to the extent that we're at, I think 3.2% right now on the inflation rate, and CPI does suggest that hopefully we're getting to an end of this current cycle. I do think that once the Fed begins to move and ease, that, my first question really, I have some thoughts, but I wanted to ask this group. What does that unlock? If there's, a rate cut in the next 3 months, how long does it take for that actually start to, one, just sort of feed into the market? And expectations, I guess, would be if it's going to continue, then it really matters. If it's going to not move for another 3 months, I think that's problematic.
Yeah, I'll start. I think really, I wouldn't think the Fed is going to go 175 basis points, right away. In fact, I'm not sure they go 175 basis points at all next year. But I do think as soon as they start cutting, even if it's just 25 basis points, I think optimism comes back into the market in places that we haven't seen it in some time. So I think there will be optimism. There'll be people that say, okay, I better start transacting now because it's only going to get better. There's only going to be more liquidity in the market, as rates continue to get cut. So I do think it's going to bring liquidity into the market. It's going to bring optimism into the market. It's going to bring, a sense that we can actually transact again, which we haven't seen in scale in some time now.
I'm just hoping for rates not to be so volatile at this point. Rates cuts would be an early holiday, right, in terms of the expectation. And who knows what's going to happen? Can't predict it. But I think we've heard higher for longer for a while. And if rates stayed higher for a little bit longer, no one loves that in terms of transactions, but at least someone can predict and underwrite to that. Whether or not the numbers work is a different story depending on the asset class and such. But if the Feds could keep rates less volatile, I think that the transaction market would really open up.
Yeah, I would definitely agree with that. But I think one of the other bits of the puzzle with rates is what would drive the Fed to cut. So right now, every single time we get another economic data point, it surprises to the upside. So this does not give the Fed a lot of incentive to start cutting rates because honestly, there's no reason to even contemplate cutting rates at this point. And so if the Fed were to cut, 175 basis points, or if the Fed is to cut at all, what that means is there's something serious going on in the economy that would trigger them to do that. And so thinking about commercial real estate and the current rate regime, I think one of the things that has happened is that, yes, higher rates have destroyed value. There's no getting around that. But the strong economy has actually helped to support cash flows. So for borrowers who have a mortgage in place, especially if it's a fixed rate mortgage, let's not talk about office. Like full stop, let's not talk about office. But for other property types, that support, that additional cash flow means these borrowers are okay. If we end up having some sort of downturn in the economy, now we have to worry about hotels, now you gotta worry about retail, you gotta worry about all these other different sectors that right now don't seem to be that much of a problem. And so, on one hand, yes, a cut in rates would be nice, but if what we have that drives that cut in rates is a real sharp downturn in the economy, I think commercial real estate has then got two problems, both loss in value and loss in cash flow. So, it's one of these things, be careful what you wish for.
Yeah, no, thank you. It's a difficult, I think, period at this point because half of me wants to say, let's see some weakness in the economy such that the Fed gets triggered to move. But too much, and then you're dealing with all of those asset classes that have held up that could start to falter as a result. So it's a little bit of a 6 in one, half dozen of another. The other question I had, which is the one that's, I think, the most concerning, is just the volume of loans maturing over the next 3 years. By my count, this year, there's some 728 billion loans that were set to mature. And that number stays not quite that elevated, but still quite high over the next 2 to 3 years. And so if you think about who holds these loans, banks hold 54%, CMBS right now around 22%, REITs 15%. I mean, it's spread pretty significantly across various lenders, but banks are somewhat significant this time around. In the past, it's been the CMBS market that held the majority of that debt. Yeah. GFC was definitely the case there.
That's right.
So I guess the question I have is that how do you manage and what are you seeing? And we might want to start with Joe in terms of loans that are maturing, really tough to refinance. Most of these went in with the 4-ish kind of coupon, and now they're looking at something 250, 300 basis points higher, if not more.
Sure. So, it's kind of the world we're living at the moment. Our servicing book is heavily weighted towards 10-year fixed rate conduits. So we're seeing 2013 vintage deals and soon to be 2014 vintage deals starting to mature. And yes, I mean, borrowers absolutely, for loans that made its way all the way to maturity, they are certainly feeling a sticker shock of the new rate environment and, versus coming out of a 4.5% loan for the last 10%, for the last 10 years. So, and it's really, there's no one size fits all approach for how we're dealing with that. I mean, generally speaking, a CMBS investor did not bargain to, own an interest in the loan past its maturity date. So, we are not inherently, in the business of refinancing loans or extending loans for any period of time. But, there is an ability to extend a loan in a CMBS deal. And just case by case, we have to look at, if we don't extend the loan, what is the alternative? Is it a foreclosure or something bad happening at the property level if there isn't a refinance. So if the answer is, something bad, the tremendous downside to not, extending a loan versus considering some kind of an extension where the borrower, typically we would require the borrower to bring something to the table. It's very rare a CMBS servicer is just, signing a piece of paper. You have 2 more, years of term on your loan. We typically are looking for something that at least delevers the loan and enhances the credit. You probably have, earned a full cash trap for that period of time. But so the ultimate outcomes are all across the board, and we're just, in the earlier innings, and we got a lot of CMBS debt maturing over the next few years. But
the majority of those loans, so that loan that was done in 2013, 10-year fixed rate loan, the majority of them have amortization?
Yeah, no, it's a really great point, and I think the short answer is, back in 2013, maybe you were getting a little bit of IO in the beginning, but it's had amortization. It's had, some years of good, run of NOI growth and rent growth. So, I think we see a lot of loans maturing. There's the sticker shock of the higher rate environment, as I said, but at the same time, I think, put office aside once again, but for a lot of CMBS loans maturing, the borrowers still believe there's an implied equity and they have something to protect. So, the friction in the workout, as you will, is, getting the borrowers to do something to protect their equity versus, trying to balance not having a bad outcome on the other side if there's no extension. So,
I think to address that from a lender perspective, there's no replacement for committed sponsorship and fresh equity. And it's interesting to hear you say that from the special servicer perspective, because there's no kind of magic to it. From a lender perspective, we're looking for the same, which I think in a lot of cases perhaps makes the refi more attractive than seeking the extension, which I'm hopeful is a trend going into 2024. As we've alluded to previously, rates stabilize and perhaps there's a little bit more visibility and price discovery with respect to valuations. So I think for that reason, not only is it a strategy, but I think it's also perhaps a positive headwind going into next year.
And maybe Harris, from an investor perspective, what's your sense of these extensions may save, sort of prevent loss at some point, but as an investor who buys a bond expecting some average life in a X vicinity, all of a sudden that doubles, or that, what does that do for you, and what does it, sort of do for the portfolio?
Well, it's not helpful. At the risk of stating the obvious, I mean, it's just another source of uncertainty, right? Because now we're not just underwriting the economic environment, the collateral's response to that economic environment. In other words, how is the collateral going to perform, whether we have a recession, whether we have the Goldilocks soft landing scenario. Now we also have to underwrite what LNR is going to do in terms of, the workout. And that's another layer that we have to consider. The other difficult thing from a portfolio management perspective is every bond that we put into portfolios, we have a variety of different fixed income strategies that we're managing capital for, but they all have certain requirements, whether it's yield, whether it's rating, whether it's risk, but particularly around duration. So at Lord Abbett, we're fortunate enough to run the largest short duration mutual fund out there. And there are very specific mandates that we have embedded into the guidelines there in terms of how long bonds are supposed to be to our base case scenario. And so when loans get transferred into the special servicer, to the extent that they are extended for some period of time and or given additional extension options beyond that contingent on performance characteristics of the collateral, that's a difficult risk for us to underwrite, and it makes us a little less comfortable, all else being equal, with the asset class.
I think also for non-CMBS loans, we obviously lend in debt funds and as a principal lender. We are open to discussions in terms of different formats and different structures, depending on what the senior lender is doing as a mezz lender. there are discussions about AB notes and trying to like tranche up the senior loan to a place where the senior lender is comfortable. The borrower puts in more equity, or we put in more equity, and that money gets priority return, et cetera, right? And so some of the discussions are happening, but it also implies cash in from somewhere, whether it's the mezz lender or the borrower. And that's an analysis that has to be taken from the borrower's perspective and the mezz lender's perspective. Is it throwing good money after bad to kind of create the extensions and such? And so you're obviously kicking the can down the road a little bit, but you are committed to the property and hoping for a better day in terms of more stability in interest rates and cap rates, resettleization and such. And so these are the tools that we can use in today's market as well.
Yeah, the worst scenario is when you have a borrower that doesn't want to put in any money, and they want you to be the solution. They don't want to put in any money. They want the lender to take the equity risk. Those are the most difficult situations. Those are situations where a lender really just doesn't want to be in. But to your point, if the equity is going to put in more money or the mezz is going to kind of take over and put in more money, then you survive. And I think I've heard so many borrowers talk about survive till 25 as being kind of the mantra right now, which is again, maybe it's kicking the can down the road, but we are in an environment where interest rates went up dramatically. There is a view that interest rates are going to go down. Hopefully it's not because there's another great recession, but there is a view that interest rates are going to come down a little bit, and even just a little bit, even a 200 basis point movement in interest rates should really help with the inflation on the top side, should really help these properties, get refinanced into a more normal market or the capital structure get refinanced.
I think the challenge there, and a couple of people have touched on this in different ways, is the path. The Fed, Jay Powell, has been very, very clear about their mandate and their interpretation of the dual mandate, and that's why we've had the most aggressive Fed hiking cycle in 40 years. Now, the forward curve is pricing about 100 basis points of cuts over mostly the second half of next year. But at the same time, I think it's difficult, and this was touched on earlier, it's difficult to imagine that forward curve being realized absent a recession. Right. And I think, so that's one issue. The other issue is, I think the magnitude, we're talking a lot about longer term fixed rate conduit debt primarily, but the thing that we haven't talked too much about is all the bridge lending that's been done, some of which has remained off balance sheet, some of which has been securitized through the CLO market, through the single asset, single borrowing market, which is about almost $500 billion of securitized debt alone. What we're seeing there are very significant problems. And we're seeing them, and it's not just office, although that's really the epicenter. We're seeing borrowers just begin to walk away from assets. They're not engaging with the investors, they're not engaging with the servicers, they're just simply walking away. And the reason they're walking away is because the magnitude of the value destruction that's occurred and the lack of transparency, given how little transaction volume has occurred on the property side, has led them to a conclusion that it's just not worth their time. It's not worth the survive to 25. They just don't want, and it's not an recourse debt, at least on the securitized side. So they have that option, and we're seeing the largest, most sophisticated borrowers on the planet begin to utilize that option in an increasing fashion. And that is, I think, dangerous precedent, but again, it also casts, I think, the industry in a more negative light, and it makes it harder to invest in these deals and securities.
If I can interject for a moment, I just want to make sure we're not overstating the doom and gloom around office. It didn't take us long to go there, and it's certainly no secret that there have been borrowers who have handed back the keys, but I think as a percentage of the kind of broader CMBS umbrella, it still is fairly limited. So I think it's important that we not overstate that and kind of play into the doom and gloom narrative that seems to be very prevalent. Whether we're talking about the SASB space or conduit for that matter, to the original prompt on strategies on what to do about this kind of wall of maturities we're speaking to, in instances where sponsors are willing to show up with fresh equity, there are pockets of capital available for office. Mm-hmm. The office market is not closed in a CMBS context. Perhaps it's a little bit more challenged in the SASB space given where AAA spreads have been at for office product, but I think we're hopeful that returns as well. And in the conduit space, we've done deals in challenged markets, including DC, Seattle. So as long as you have the right sponsorship willing to demonstrate long-term commitment to assets, there is availability of financing even in the office sector.
So in the office sector, to get an office loan into a conduit right now, what is it, 20%?
25 if you're
maybe?
including mixed use as well.
What about the LTV? I mean, can you put a full leverage deal into?
What's full leverage? It depends what the cap rate is, right?
What's the value?
Yeah, exactly. If it's stock debt yield, so could you put something that has a single-digit debt yield, office single-digit debt yield into a conduit?
It may be challenging. It depends on the market. I think the discussion of full leverage is dependent on whether the cap rate we're applying has caught up. And to a large degree, that perhaps hasn't happened yet.
Right.
I think the price discovery we've all kind of alluded to, assuming it takes place in 2024, I think opens that market up a little bit. Not only because in a lot of instances, borrowers will kind of finally get that punch to the gut that they will need to come to the table with fresh equity, but it also brings capital for acquisitions back to the table as well. I think we need buyers and sellers to get a little bit closer, and I think rate stability is really going to be the primary driver of making that happen.
Yeah, the interesting thing about office, and I talk to banks from around the world, I talk to investors from around the world, there's a lot of really smart industry professionals that look at this as, well, there's not a lot of people in the office space. There should be a lot of good opportunities, and there probably are, but I have investors that gave me the money and all they do is ask me what my office exposure is. I just don't want to do, even if it's the greatest deal, just don't want to do that deal because I don't want to have to explain to my investors why my office exposure is X. I think that will change. I think once people start to see the conversion of some of these office properties, the actual lease of some of these office properties, that'll change. But right now, thanks to all the talking heads, namely, it's got a taint on it that is really still tough to deal with.
But let me ask this to Tan in sort of debt fund space. A lot of what you do is transitional, not everything, but a lot. Does this present an opportunity for the debt funds? I can imagine there's also a significant amount of risks in the current environment.
It's exactly that, both. I think, so in the debt fund space, there's not a lot of liquidity right now, as people know. So it's an opportunity for alternative lenders like debt funds to come into the market and take on some of this market share where it was very highly competitive, a year and a half ago before rates started going up. But it is a double-edged sword. There are these opportunities. However, you have to really be selective about these opportunities because it's floating rate business, it's transitional business. Do business plans work in the shorter-ish term that we're talking about, right? And we own 1,200, 1,400 properties throughout the US at Clarion Partners. And so there's a lot of clarity in terms of operations and business plans and such. And we like to think there's a lot of clarity in terms of valuations. There's not a lot of transparency in terms of where values are. So it's hard to kind of pin that loan to value. So, pre this period, our funds, our clients, the appetite was 75 to 85% loan to value. Proceeds are down, obviously, because valuations are a little bit in flux, and we just want to be able to underwrite to an exit that makes sense. And that's how we're handling it, right? The coupons are pretty significant coupons. So for plus 5, 4, 5, 6, 7, 8, 10, whatever it is, depending on the risk spectrum of what we're doing. And so a lot of it is bridge to stabilization, and I'll talk about that in 1 second. And a lot of it is construction loans. On the bridge to stabilization, a lot of these folks were starting to build 3-4 years ago, and they thought they could kind of stabilize and take out with a Fannie Freddie. Well, obviously construction loans are due. They haven't gotten to that point where it has stabilized to just kind of take it out with perm. So you come in and put in some short-term financing, and those, are earning anywhere between high singles to low doubles, depending on what the proceeds look like. Someone talked about this before in terms of the whole loan space. We used to do just subordinate debt on mezz in terms of construction loans because that's where you could get the better risk-adjusted returns. And our book of business has turned more to senior lending when it comes to construction lending because you can be at lower loan to value, loan to cost, but still get significant returns there. But you kind of have to kind of understand where the market is and really look to your exit. No one knows where interest rates are going to be. No one knows where the takeout market's going to be. And all the deals take a lot longer to lease up, et cetera, so build more time into the business plan.
That's like the invisible hand of our industry, right? If you think about construction loans, which 2.5 years ago were SOFR 200, throw some recourse, SOFR 180 for the right deal. Now they're talking.
I'm coming to Citibank as an equity.
We don't do construction lending, so, but there are a few guys. But my point is so, I mean, now you're doing construction loans and the borrower's paying 9%, 12%.
On a senior basis, it's probably SOFR plus anywhere between 3 to 4 or 5, depending on if there's some recourse there.
Yeah, so you're called 9%. So I mean, that's going to limit supply, right? So that's going to limit supply. That's going to help with this industry. That's going to help us kind of get out of this. There's really, I mean, if you look at construction starts for the next couple of years, I mean, there's certainly a lot getting delivered this year, next year, but construction starts are next to nothing.
Yeah, we won't have a problem in like 2 to 3 years in terms of oversupply.
That's right, which is good.
While we're on the topic of debt funds, one of the things I did want to note is that CREFC has been working with NCREF for the last 3 or 4 years in developing a debt fund index. So I think it's going to be really positive because it adds transparency to a sector right now that folks are kind of getting used to, but it's going to sort of, by fund, we'll talk about what products you're involved in. And what financing vehicles. And so I do think it does lend not only a little bit of transparency today, but more importantly, as you move forward and you see how some of these investments and loans and whatever they are have performed.
CREFC's doing an amazing job with this. Because we are a PE-style business, these funds are aggregated with investors. On the equity side, that marketplace has been institutionalized for a very long time, and there's a benchmark associated with. On the debt side, relatively new in terms of benchmarking. So when you walk into an investor's office, they're like, well, what is this benchmarked against? Like, we don't know. Fixed income is akin to fixed income. Maybe it's not, maybe it is. So a debt fund index benchmark, it becomes really important to the investor base as well as folks who run funds.
Great, no, thank you. Lee, question for you. One of the things that astounds me is the low level of delinquencies that we've seen. If we were described just in a box by ourselves to say, here's the environment, what do you think the delinquency rate would be? I would have thought we were getting very close to double digits, if not there already. Maybe I'm being aggressive, but it's not what it is today, which is what, for 4%?
Yeah, we're at 4%. Conduit delinquency rates are 4%. SASB delinquency rates are 4%. It's kind of 4%'s the number. So one of the things about commercial real estate, well, there's two bits. One of them is what I mentioned before. We've actually had decent GDP growth. It's surprised to the upside. It has supported cash flows. Again, office aside, everything else seems to be ticking along pretty well. So that certainly helps. When you look at what drives delinquencies, it tends to be debt service coverage ratio related rather than LTV. That's not entirely true. If somebody is on the border, then if they're underwater, they may be less likely to support it. But by and large, your primary driver is that debt service coverage ratio. So as long as your cash flow is good, the borrower keeps paying. But the other bit I have to point out is that historical CMBS underwriting standards have been really good. So coming into this, the debt service coverage ratios on a lot of these loans were well over 2 times. So, okay, they get chopped by some 10% or whatever, you're still well above that 1 times level. And so I think one of the things we learned coming out of the great financial crisis is that stabilized loans need to be not as aggressive as they were. We're not underwriting fictitious cash flows. The LTVs are relatively low. Aside from the last couple of years, they've been in around the 60% range. Recently, they've been even lower than this. So there's a lot of cushion built into the structure of what goes into a CMBS loan, which has therefore kept the delinquency rates low. The one thing about it, though, when we look at trends, we're definitely moving higher, both in conduit and on the SASB side, single asset, single borrower. So conduit loans, the driver of it is, guess what? Office. The rest of the property types look pretty stable, but office delinquencies are definitely starting to trend up. On the SASB side, the single asset, single borrower, the problem is that a lot of these loans are floating rate. And so what's happened with interest rates gets transmitted directly to these borrowers' debt service coverage ratios. So a lot of these borrowers have rate caps. There's a lot of complications in this. But at the end of the day, the floating rate borrower feels the impact of what's gone on with rates much quicker. And so historically, SASB delinquency rates have been well inside condo. It's like near nothing, because these are big properties, they're sophisticated borrowers, all the things about, trophy assets. But now these borrowers, even the best borrowers, are looking at these and trying to make a call. Do I keep feeding the deal or do I pull the plug on it? And now we're seeing more and more make the decision that, this is really not the type of asset they want to have long term.
Right. Job, what are you seeing in terms of the type of asset that's coming into your shop right now? Is it mostly office? Are there any things one of the numbers that sort of surprised me was, especially in the CMBS market, it looks like multifamily is really kind of suffering as well. If you just look at the absolute delinquency numbers there, I was surprised. I've always thought about it, sort of stable asset class, better underwritten than it was in 2007.
Right, although I think multi-delinquency is creeping up in the CLO floating rate last few months, but yes. But to answer your question, it's no surprise, probably, 60% plus, of what we've seen this year is office. And, behind that, there's still, fortunately, we're not talking about malls as much as we used to, but there still is a universe of, malls that were financed in 2013 and 14 that still have cash flow and made it to maturity. There's a couple different buckets of malls. There's the strongest malls, and then kind of the middle tier that are, solid malls that have a reason to exist and have solid cash flow, but there's still a double-digit, cap rate valuation at maturity. So we still see, those, but absolutely, it's dominated, by office. And I'd just like to add to something I think Harris mentioned earlier about, you see it on office in particular, borrowers starting to, capitulate and just walk away. And I think what's really, what we're observing is, office loans tend to be bigger, higher structure, and, there's a lot of mezz out there. And, we see borrowers that still have the will and the desire to reinvest in the property and try and work it out, but there's so much mezz out there, and a lot of the holders of these mezz have no ability or desire to call capital. They never expected to be in the position they are, but a lot of subordinate debt, mezz in particular, that is quite frankly paralyzing any prospects for a workout. So,
thanks, Harris. The other Harris, you sat next to each other too. As an investor, what are you buying that you feel comfortable with right now? So within the SASB market, are you buying office in SASB where you're seeing these large deals? And I suspect if it's the right asset, you're probably comfortable enough, especially given the underwriting and credit enhancement.
Yeah, sure. So look, we're one of the largest single asset, single borrower investors in the industry. I would say we continue to be very active in the market, both buying and selling. We've candidly been better sellers over the last 18 months for a variety of reasons, a lot of which have already been covered on this panel. But yeah, every day we're both buying and selling bonds. In terms of the property types, we have bought office deals. The headlines and the narrative around the office, while you could make, I think, a very credible argument that it's very justified, has driven just an enormous amount of dislocation. I'll give you an example. From about a week ago, we were looking at selling a BBB- rated single asset, single borrower deal, a bond that was collateralized by an office asset. And we had a reserve level in mind for where we were looking to sell this risk. And the best bid that we got on it was 40 points below our reserve. And so that's true for BBB risk, even for AAA risk. Just within the office single asset, single borrower space, you can buy bonds that are 6.5% yield. You could buy bonds that are 10% yield, 11% yield. And that's for AAA risk. which tells you it's not really AAA risk, obviously, but it just does highlight, I think, just the magnitude of the dislocation that's in the market and just the absolute lack of liquidity that we're seeing in trading markets for this kind of risk. It's not as bad in other types of single asset, single borrower, the COVID winners like industrial, for example, life science deals. Those have held in better, but still trading, even at the AAA level, at spreads that are, call it generically 75 to 100 basis points wider today than where they were 18, 24 months ago.
That's do you actually go out and when you do that price discovery and you find that, do you go out and find those bonds to actually buy them?
Sometimes.
Yeah.
Sometimes.
Do you see an appropriate differentiation between credit within asset classes? So you referenced one office deal. Do you think that's a binary across the entire sector, or do you think the market is appropriately differentiating between deals?
I don't. But again, the level of pessimism that exists right now, I think in CMBS just broadly, particularly for single asset, single borrower, and office single asset, single borrower in particular, it's really, really difficult to transact. Investors don't want to buy bonds, certainly at asset managers, because why would you? There's a wide opportunity set out there in fixed income credit markets. There's a lot of pockets of dislocation away from CMBS and certainly in CMBS that you don't have to commit capital to this space. I think a lot of hedge funds have gotten really hurt in CMBS over the last 18 months and a lot of them don't have the ability to come in. You're seeing family office money and some crossover accounts beginning to come into the sector and allocate capital. But again, it hasn't been enough to deal with the dislocation, and the dealer community is largely absent from, well, more or less everything these days. So it's going to take time, I think, to heal this market. A lot of the stuff that folks said earlier around the economy, and if we can continue to see resiliency in the economy, if the Fed is in fact done hiking, which is certainly the market's view and my personal view, that will go a long way in helping shore up net operating incomes and bring cap rates down a little bit, and that stability will help transaction volumes, which in turn will help the debt markets. But right now, it's tough sledding out there.
Yeah. One of the things I did want to touch on is the issue of new regulation that has come down over the last couple of months, year, that would be very detrimental to the commercial real estate lending markets in general. Most recently, we've had Basel, you might have heard Basel IV, the so-called endgame, in many ways.
Like, come on, it sounds like a Hunger Game.
Yeah.
What is it, the Avenger Endgame?
Yeah.
It really is called, if you go on the FDIC's or any of the regulators' website, they literally call it
the endgame.
The endgame.
Yeah. It's not a good thing. But really what that does is that it pushes a lot of the origination, commercial real estate origination, outside of the banks. So the ability to hold a whole loan on your books as a bank is going to be far more expensive than if you were holding a CMBS or a securitization. In many ways, I think it does all the wrong things in that, yes, you have the securitization markets. Oftentimes they're housed in banks, I'll take that. But to the extent that you want different, lots of oars in the water in terms of the ability to go to different places that will do different things depending on what you're looking for from a lending perspective. And so I do think that's one rule. And then there were two others that the SEC has been extremely busy on. And I'll be brief because it's somewhat arcane, but in essence, this rule 15C211, who cares, right, what it's called? It means nothing to any of us until you start reading it. And what it does is basically say you're going to take a SASB that's a 144A private transaction, and if you want to actually put that in the market, then you would need to divulge all of the private information that comes from that transaction. So like the New York Times and the Wall Street Journal can take a stab at it. So to the extent that we were able, we got a win there. They passed, they rescinded, and that was a good thing.
Thanks to you.
Yeah, with just me, yeah.
You are amazing in Washington, so it really is because of
But then there's also this other conflict of interest rule that basically says all of the parties in a CMBS deal are conflicted, and so that's a problem. We recently got, particularly the bottom of the transaction, so that B-piece investor who at times can look at a loan and shape a pool or help shape a pool. And it's always done to the good. It's never done such that the SEC was thinking you could shape a pool that is so horrible that you can then short that pool and make money. There is no efficient way that I would arguably say to short a CMBS transaction. And so to the extent that it was a silly rule to begin with, they just sort of pulled back on that as well, not 100%. But you know, my sense is, and the concern that I have, is that these regulators are busy doing, I'm not sure what problem are they fixing, where there are much larger problems in the world right now than whatever these arcane sort of rules that they're coming up with to address issues that don't exist. So we are being vigilant about it, but I would not be surprised if we continue to see this onslaught of what I think is just sort of a downturn in debt liquidity if they were continuing to do this at a time when coupons are upside down and it really makes it difficult to refinance or to even secure new debt, right?
Yeah, and I 100% agree with every single thing that you just said. I will say this though, and I wasn't kidding. I mean, Lisa and her team are amazing in DC, and when these regulations are being discussed, I mean, I assume you submitted a letter today to.
We submit letters.
On Basel III.
Mm-hmm.
So, I mean, there's a conversation to be had. I mean, the regulators, the legislators, they want to hear from Lisa, they want to hear from the industry, and I trust that the proposed rules for Basel, for the endgame, are not going to be the rules, because I think the industry will listen, or the regulators rather, and legislators, and quite frankly, if not, we got the Supreme Court now, right?
That's true. And there's a lot in there, so I don't even think we've kind of gotten to everything.
Right.
Lee, do you have an issue or questions on that, or sort of thoughts on what you're hearing regarding the same? Is it anything different on Basel, on some of the others?
You know, honestly, Lisa, the destruction in value in other parts of commercial real estate have really driven the majority of my conversations over the last year.
Yeah.
I think kudos to you and CREFC for keeping these items on people's radars. Because I think, broadly speaking, the investor base, everybody who's in the trenches, is somewhat overwhelmed with the amount of distress that's going on out there, away from what's happening in Washington. And so, thank you, really, for making sure that these don't fall in the cracks and we get blindsided by something else that comes along.
Yeah. And I just, my sense is that this isn't going to stop. I think Mr. Gensler is very active, wants to be involved, keeps looking for things to fix. I wish he'd focus on things that need fixing. So that would be my end game here. I guess I have a few other questions, but it really is, let's see, what do we have here? I think, Job, I wanted to ask about servicing. I'm sorry,
Sure.
I have to ask. In the past during GFC, it was a kind of dissension everywhere. There was not one party that was happy ever on all of these things, and for good reason. I think some of those loans were not, originated at the right LTV coverage with structure that they needed that they didn't have or didn't have enough of. So in this current environment, we talked a little bit what you're going to do with maturities that are coming due, and if an extension makes sense, you'll do that, and if not, and yes, an additional money in can also be helpful just to make it more reasonable. But can you talk through sort of a normal extension, like what's the term of those extensions, and what are the goals, and what kind of sort of cooperation do you need from both your side, their side to get things done?
Well, the short answer is as short as possible.
Yeah.
I think I mentioned.
And that's
before.
Harris's point, right?
What's that? Yeah.
That's Harris's point as well.
Right.
Short is good.
Right, and we also we say no quite a bit to extensions, and we have there's quite a few borrowers that approach the special servicer, really maybe a bit of forum shopping. They have a potential takeout, but there's, as I said before, sticker shock from where the rate is, and I think they have a discussion with a special servicer, and not all special servicers have equal approaches, but I think if they were talking to us, they would realize that the workout with the special may not be the best option. They're going to have to bring something to the table, make a pay down, replenish reserves. They're probably going to be in a full cash trap, the whole time. So, the point is, as I said, we will do a workout if we determine the alternative of a foreclosure and a liquidation is a really bad outcome and a really bad loss. But it's always keeping the duration, as short as possible, and it shouldn't be just a liquidity source to maintain a low interest rate loan for the next couple of years. So,
Right.
but it's usually not more than a couple of years. We're not doing 10-year extensions ever, and rarely do you see 5-year. It's usually somewhere between, a number of months and a couple of years would be the norm.
Chris, let me ask you, so, the issuance in the CMBS market and the structured finance markets are down significantly. Are you seeing a pickup on the other side? And
We're not. We're not seeing, it comes down to value. It comes down to buyers, or really sellers, really trying to hold on. And so transaction volume is down dramatically, right? And so we're really not seeing pickup. I will say, the M&A related conversations are starting to pick up. And so that is usually a good sign. Typically we see when M&A activity discussions, even if it's high level discussions, start to pick up, that's an indication of people are ready to go, people are ready to pounce. And we actually just closed a bridge loan on a take private for hospitality REIT yesterday, and there's been a few others that have happened this year. But the mere fact that the conversations really have picked up, I think, is a good sign. But to answer your question directly, we really haven't seen a lot of requests out there, quite frankly. We're standing in the way of that bar out there.
No, I just saw 14 seconds left. We won't do the countdown, but I want to thank you all for the great conversation, and I think we don't want to stand in front of cocktails. Thank you.